Good morning, everyone, and welcome back to another episode of Trade with Conviction. Today is Thursday, 12th of March, and I'm joined by James, Jorge, and Neil. Guys, good morning. How are you? All good?
Yeah, very well, thanks.
Yeah, good morning.
Good morning.
All good.
So another eventful couple of days, to say the least. Let's maybe start with a summary of the news of what's going on, what has happened over the last, since the last podcast on Monday. Neil, can you give us an update, please?
Yeah, so I'll take two things, and then Jorge, you can do all the infrastructure damage that has happened in the last couple of days. But there were two obvious things that happened in the last couple of days. The first was that the US administration is clearly in damage control in terms of the oil price. So loads of things were being tweeted around, right? We had this incident where I think when markets were even closed, the US was talking about US naval escorts that had been successful, and then it turned out that hadn't happened. And then the tweet got deleted. Obviously, Trump has been talking down the duration of the Iran war. So he's trying to basically say this will be over soon, when it's quite clear from the conflict itself and the news flow that we're not anywhere near there yet. And there are rumors that the US Treasury is intervening in terms of oil swaps. And that was all helping to, let's say, hem in the flat price of oil, because obviously the US is interested in damage control, right, on those terms. And another thing that was helping that was the constant threat of SPR release, and that's what I'll talk about in 1 minute. But I think if you look at flat price today, we're almost at $100 again. There's only so long you can actually play that game, right? Because there were 6 tanker attacks in the last 24 hours. More ports got blown up. You can't control that in terms of the impact on the market psyche. And just to give you a piece of data there, I'm having a little eye on the EIA publishes the weekly national average retail gasoline price, and that rose 50 cents per gallon week on week. And I believe the diesel flat price is also even higher. There's a guy on Twitter called Gas Buddy. He's been around for ages, and he's telling us that the diesel price has risen $1 per gallon already. So the consumers are going to feel this. And I always read the UK papers, right? Some of the tabloids, and you get these stories about customers who normally fill up their heating oil tanks, and the price doubled from last time already. And so they go, oh, well, maybe I take a bit less, or maybe I don't do it this month. So you can already see the demand impact in Europe, let alone, all the governments already rationing stuff in Asia. So the price is going to have an impact pretty quick.
Yeah,
indeed.
And the next thing was the SPR release. We finally got the SPR release. It was the biggest release in history, and it goes only a small way to plugging the biggest hole in supply in history, right? So again, flat price doesn't care about it because the rate of release is too small, as we've been saying for days and days and days. In fact, the US will be the largest chunk of this, and they're going to do their 100 million or so over 3 months. That's about 1.2 million barrels per day. Again, it's kind of small change, isn't it? I mean, it doesn't go nearly far enough to actually help in this situation. What it will do is it might distort some east-west prices. So we're going to get crude release in Asia. So it's going to reduce Asia's call on Western crude at the margin. It's going to increase crude supply in the west of Suez in terms of the US. So now we're going to have lower freight rates and more supply of crude in the US. So it's, in theory, going to get easier to push crude to the east if they want it. And there'll likely be a distillate release. And basically the big distillate chunk is in Europe. And if Europe releases distillates, that's going to go some way to helping Europe's distillate short. So me and James have been having this discussion for ages. Who's going to be shorter if Asia cuts 5 million runs, or if Europe releases some SPR and maxes runs? We'll find out, but
yes,
distillate's going to be in Europe.
Yeah.
Interesting. Yeah. And 5 million isn't necessarily at the high end of the range. Oh, well, you're talking just distillate.
I'm just talking distillate now. Yeah. The total release is 400 million barrels, but it will be over several months. And for the IEA party countries, that's already a quarter of the reserve, right?
Yeah.
So, it's tricky.
Anything else on Hormuz, maybe?
I mean, I just think the market, and I go on to talk about this in the little crude section, but I think there's parts of the market that still think this thing's too big to fail. And I agree with it in the sense that we can't just have this hole in supply. So either something will happen in the next couple of weeks, it could be boots on the ground, but a bigger one will be that governments are going to have to intervene more and more. And one thing that I've noticed is, Koreans are going to implement a price cap. That's the wrong thing, because we need to get rid of demand. We don't need to encourage demand.
Indeed. Yeah.
And the problem there is that you saw what happened during the COVID lockdowns. How much did people hate that? And can you imagine in Europe or the US, governments start to say, hey, you can't drive on 2 days of the week. It's going to be carnage politically.
Well, talking about carnage, let's continue with the rest of the infrastructure issues that we've seen over the last days. Let me go through the list because it's a long one. I admit I didn't memorize it, so let me read it. First of all, let's start with the tanker attacks. This was, we've been having this since the beginning, but it wasn't a sort of steady attack on tankers. But yesterday, I believe there were two tankers and another container ship that were attacked over the last 42 hours. And it looks like these attacks might have slowed down, but the owners are more likely to stay away now, So despite all of the talks of Trump and the escorted transit, well, at the end of the day, perception is reality. One thing is what you've been told, but if you don't dare to move, then by default, everything is blocked. Now, the threat of mines, that was perhaps unexpected, but it is extremely powerful, and that has been happening. So the other big news was reprice. Okay, let's not forget this is a 900,000 barrel a day capacity. This is huge. So that was impacted, and correct me if I'm wrong, guys, but it is shut down entirely or partially, or what's the status there?
Don't know the exact status, but I think it's mostly shut down.
Shut down. Again, this is going to reshift a little bit the balance of imports for the UAE, if actually they can get product to flow into Ruwais, So now we're talking here basically run cuts and attacks all at the same time. Well, we've been saying the word messy from the beginning, but it's just a nonstop flow of again run cuts and attacks. To continue with it, we had Iraq shutting out an oil terminal today after strikes on Basra port. Saudi intercepted more drones over the large oil fields, which is, if you think about it, that's super scary.
Yes.
Mina al-Fahal port in Oman. So that's a crude port. I believe it's linked to Dubai benchmark, correct? So that plus Fujairah, that's having an impact on Dubai pricing. So basically most of the Dubai benchmark crude is now largely off alongside Murban. Again, I'm just reading this and it feels surreal.
It's huge.
It just feels surreal as I read it. Sorry to make a pause there, but it's just very surprising. So the direction of travel continues to be more closures here. So and this is not it. We have more. Fujairah, Murban, one load from Fujairah. Okay, the decision by ADNOC is being contested, but clearly recent attacks on the port make it difficult. So this is one of the two crudes that go through the pipeline of ADCOP. So that option is now semi-gone, which was one of the reliefs. Yeah. And again, that the other relief pipeline was Yanbu. So the loadings have reportedly hit 2.5 million barrels a day. The max is assumed to be 4 million barrels a day, although they are, Aramco is claiming or saying that it could go up to 7 million. But again, even the 4 million has never been tested. So cautious, we need to be cautious about that 7 million number. There are also more oil products coming out of Yanbu. That's good. Some 300,000 barrels a day. So again, this is just... Maybe we don't even have the full list, but this list already is unprecedented. It's just crazy.
Yeah, it's unbelievable. Yeah. And just one thing on East-West, right? Just to clarify. So Aramco are giving out the headlines that soon they will be doing 7 million barrels per day on the East-West pipeline.
Yeah.
But that is not the bottleneck. The bottleneck is what Yanbu can load. So at least 1 million barrels per day of that 7 on the pipeline goes to feeding refineries on the West Coast. And then there's the extra bottleneck of Yanbu. So the 7 that they are claiming could actually be 4.
Yeah.
Okay, understood. Sorry, thanks for the correction there. Jorge, that's not it. That's just the Gulf situation. But obviously, we keep hearing more force majeure announcements. What can you tell us about that?
Yeah, we've seen the supply side, which obviously is a very big story, but we have also a very big story on the demand side. So the Far East, Southeast Asia, India, they rely on Middle East exports for crude, but not only for crude, also to feed the petrochemical industry. And this has been, we are seeing a very huge impact on this. So most of the force majeure announcement that we have seen comes either from petrochemical companies or for integrated companies that has the refinery and also the petrochemical plant. We are seeing, I won't have the list because the list would be too long, but we are seeing 1 or 2 announcements per day, and some days even 3. And this is mainly impacting the main hubs for steam cracker production, so for ethylene production. So we are seeing them in Korea, we are seeing them in Japan, Taiwan, Indonesia. Then we have a very big story in India, but we will see it later. And according to our numbers, like 20% of the ethylene production has already announced force majeure for or reduced the operation rates. So the impact is being huge. We are facing a lack of short-term supply for the petrochemical complex, and the ones with the highest demand from Middle East are Korea and Japan. Then we have China, which is also a very big story, but it's a little different because it relies more on LPG. A higher percentage of their feedstocks is LPG, and it comes, and also ethane, and it comes from the US Gulf Coast. It will be impacted anyway, but the main impact, and we are seeing already, it's in Korea. And we will see later the impact on the prices. I think we can now move to the product side.
Moving on to pricing and the products. So James, you want to start with distillates? Give us your perspective of what's going on.
Yeah, for sure. Well, it almost feels a bit controversial to say, but it continues to be middle distillates that is the most affected part of the barrel. But I mean, everything is so tragically affected. But everything in diesel and jet pricing at the moment is just unreal, historic extremes at the moment. The HOGO started to rip yesterday. It was already massively elevated. PAD 1's trying to protect diesel supplies. And also we had US announcements about RINs yesterday that also added fuel to that fire. We've seen the east-west on both gas oil and jet. They just look broken, to be honest. Singapore diesel absolutely ripped yesterday, and prompt regrade followed it. I mean, this has been enough. Even, I think Felipe spoke briefly about Yanbu product exports. Yanbu loaders for diesel, probably for jet as well, look like they point east at the moment. I mean, that is just unbelievable. And this is going to continue to be very volatile. It's just really commentary from like our contacts that it's just really untradeable, the east-west now. We've seen LA jet premium particularly, but also diesel premium don't look that great, really responding. Of course, the LA Los Angeles short will just be really hard to fill now because of run cuts in Asia. That's where it's been get most of its supply from. And the ARBs in that place are just really, really shut into LA. I mean, it would help if the Jones Act relief would come into force. But this is more of a solver, I guess, for PAD 1. I'm not really sure where LA gets resupply from at the moment, to be honest. Perhaps levels are so high that they can force US Gulf exports through the Panama Canal. But to be honest, everyone wants US Gulf product exports at the moment. So, yeah. So we've got lack of ARBs open for diesel and jet, into the US West Coast, into New York greater region, into Northwest Europe, into the Med. There's run cuts in Asia, so the ARBs on paper look open into Singapore, but will they actually flow? That story is true for diesel and jet. There just doesn't really seem to be any real solver for diesel and jet pricing at the moment. I mean, how can you think about what the fair value is for diesel spreads now? It's unreal. Added to this, we had announcements about issues at Pernos, or shutdowns at Pernos hydrocracker as well in Europe. The only solver really for like distillate pricing really seems to be like an extremely fast resolution of this conflict and a speedy repair of all those infrastructure damages that you listed, Felipe. But that's months rather than weeks, even if we resolve the conflict.
No. Yeah, one thing's for sure is that even we're not even 2 weeks in and going back to sort of normal, we're not anywhere close to that. You know, it's going to take. Already at the end of last week, June was anticipating 2.5 months for Asian refiners, and now we're with the new attacks and new infrastructure attacks and all that. It's just going to be a very, very long time to get back to normal, even if things stop today. which again remains very unlikely because of all the things we said.
Yeah, I mean, I personally think the East-West is doing what it needs to now, because we've had this conversation like, what should the East-West be positive? And obviously, maybe we can exclude March, which is currently plus $213 per ton.
Yeah.
But even April is plus 20.
Yeah.
I think that's what it needs to be, because Asia's just going to be shorter, and the solver is going to be government intervention, miners drawing on SPR crude in the East because there are not too many products, and some combination of that plus sending Yanbu volumes east. I think that's the temporary solver. It's a horrible situation, but I think this is almost fair value, not plus $213 per ton, but the direction is fair.
Yeah. And but again, you were mentioning that Europe might release all of these diesel SPRs. Theoretically, that should stay in Europe. At least you would expect the European government to keep it in Europe.
I mean, I think it's designed to do that, right? I think I'll do this for next time. I have to figure out how it gets released. Does it go directly onto tankers and then into fuel ports?
Exactly, that's the point. Because if the trader's job is to optimize, so if you can buy the SPR diesel and ship it to Asia, well, that is the function of the market. But I wonder if that will happen, because it would be almost absurd.
Yeah.
Anyway, so sorry to interrupt, James.
No
Anything
worries.
else to add on the distillate side?
No, I don't think so. I was looking forward to hearing Jorge on light ends, actually.
Okay, Jorge, what can you tell us on light ends, naphtha, gasoline?
Yeah, so first on the pricing side, compared to the last podcast that we recorded on Monday, we have kept seeing the same trend on East-West. On gasoline, we are seeing new highs for March and April contract, another +4 and +2 per barrel there. And also on East-West naphtha, we have seen a very big change. So the prompt East-West naphtha is trading above 100 at $125 per metric ton. Probably in 5 minutes, it will be a different number, because it's becoming very volatile at the moment. But at the current levels, compared to previous Monday, is another $30 per metric ton. So the historical average of naphtha East-West is around +15. And we are adding in 4 days $30 per metric ton. So this gives us a measure of how this spread is trading at the moment. And this is obviously having an impact on the ARBs. We have been talking a lot about this. So the East will need more imports from the West. And this is already being felt in the arbitrage calculation due to the East-West skyrocketing. So in gasoline, we already talked about this on Monday, but the trend continues. We are seeing more and more outlets that find in ARA the cheapest option. We have Australia, East Africa, and Pakistan via Cape of Good Hope. And in naphtha, it's the same. We saw a small delay on naphtha, but right now we are seeing the previous levels that I've talked about East-West, and also the cash diffs are skyrocketing. In the beginning of the week, we were talking about +$60 per metric ton. Before the conflict, it was at +$10 per metric ton. And right now, it's very hard to measure because nothing is really trading out of the E. But the last estimation could be that the cash diff for naphtha to deliver into Japan or Korea could be above $100. We will keep trying to find the fair value for this, because right now it's very, very hard to measure. Yeah, we will, with these numbers, we will see the flow of rising from Europe and from US into Asia. The supply that we are losing from the E of naphtha, it's around 4 or 5 million tons per month. Western players, Europe and the US, they can go up to 2 million, maybe 2.5. We have never seen a situation like this, but the historical record is around 2 million. So we cannot even compensate 50% of the supply that we are losing for naphtha from Middle East. And that's why we are seeing all the force majeure that we have talked in the beginning, because the petchem industry is not able to get the supply that they need to keep running the plants, or at least keep running in the same operation rate. So this is all from the pricing and the arbitrage side. And then looking at the spreads between different products, we have gas nap. It has corrected slightly since Monday, but the levels remain above the beginning of the war. We will probably see some comeback on this, because we've talked about all the petchem plants struggling with the short-term demand. So naphtha could be a short-term impact, and gasoline could be seen a little bit later. So this could impact also on the spread. And then we have propane naphtha. It's another $40 per metric ton lower than before the attack. And it's linked to a very big story in India. I have already mentioned this in the beginning, because India is a very big importer of Middle East supply. They get close to 90% of their imports from the Middle East. And the impact is not just to feed the steam crackers. It's for demand, for cooking demand, also for heating. So the impact is immediate in the houses. If there is a spike in propane Far East, we are seeing it. It's gonna be felt in India in the very short term, and it could be linked to a higher inflation very quickly, because all the houses will feel it in the short term. We are seeing the government instructing the refineries to maximize the LPG production. So this means less of this will go to the petrochemical pool as a feedstock, and more will go to the market directly to be used as a cooking or as a heating in the houses. And with this, we can move to freight. James?
Yeah, well, as we kind of alluded to earlier, so we've seen dirty and clean tankers just increasingly ballasting everywhere to get safe routes and to make, unbelievable freight rates now, but primarily the Atlantic. And sure enough, we've seen increasing tonnage lists in WAF, in the US Gulf, in the North Sea as well. And these are just growing day by day, week by week. The open count of VLCCs in the US Gulf are at year-to-date highs currently. And the average USG count is also lengthening rapidly as well. If West to East crude demand doesn't pick up and support this, then rates surely have to drop further. They're ballasting here to make that possible, essentially. And clean products, basically the same. If we don't see US Gulf product exports, we should see the same kind of drop in TC14 as well.
Thank you. Neil, let's just wrap up with crude then. What is your perspective on crude right now?
Yeah, I'll do crude and fuel oil, and it's really related to what James has just been saying about freight. And to sort of caveat this, or to give the background, hardly anything has happened on the physical diffs yet for WAF, for North Sea, for Black Sea. There was upside in things like majeures, which comes out the US Gulf Coast. There was upside in the Guyanan crude, but that is also corrected downwards. So majeures is now pricing at a sort of flat to TI Brent, whereas it was +4 a few days ago. So the physical market in the west of Suez is not ripping, so to speak. And I'm trying to figure out why that is. I was suggesting last week that actually the Asians are going to struggle to take these extreme freight rates. And yes, they've got to pick up a bit of base load. They're probably doing that in LATAM, for example. But generally speaking, it's very, very tricky for refiners. You can look at our landed margins in Asia for many crudes. Those are struggling, believe it or not, because of the cost of freight. And I think it's possibly difficult to hedge. We've talked a bit about what happens if you hedge the margin and then you don't have any crude to run? I think logistically, it's just very, very difficult for the Asians. So they have not completely ripped into the West of Suez market yet. And I was talking to some contacts. The same is actually almost true in Europe. So there's so much freight risk. You prefer to go to the CIF market for WTI in Northwest Europe. You prefer to go to basically very short haul crudes. And European refiners might even be reticent to pick up Brazilian or Guyanan crude right now. So it's very strange. And yeah, it hasn't resulted yet in a super tight crude market in the West. And there's a couple of things I think need to happen to help here or to change the picture. One of them is freight getting crude from west to east needs to drop. And James, you've just been talking about that year-to-date high VLCCs building up in the US Gulf Coast. That will help a bit. I think Asian cracks, generally speaking, believe it or not, might be too low. But again, if you don't have crude to run, maybe that doesn't even help. And I seriously think it points towards the Asian refiners are just very much struggling, and government's going to need to step in and give them more and more crude and help out more on the demand side. I think that is more the solver just now. And we know that there can't just be an endless bidding war for the crude until the crude becomes, until crude diffs become $30 per barrel or something versus dated. That's just not going to work out. So it's a very strange crude market, I have to say. And the big driver is you've got these huge changes in demand in the East and maybe even a little bit of reticence for demand in the West. And now we're going to add SPR in the East and the West, particularly out to the US. And we're in a strange situation where the physical market might even weaken.
Well, yes, I'm very confused with this physical market story, because on the one hand, when you have spreads and flat price increasing dramatically, you can have cash dips coming off because the job is done, maybe one, but here the problem is a pull, or it should be a pull from the physical side. And if you're telling me that the buyers are looking for that SPR crude coming in and governments helping and all that, again, that the story is that I don't have enough crude, I need someone to supply me physical crude. And so you would expect those cash dips to be almost driving the spreads instead of compensating for the spread strength. So I'm a bit confused how you can be in a situation where people will be taking all of the SPR crude, but at the same time, those cash dips in WAF, which again is not affected. You can, you have that visibility. If you can find the freight, a vessel, you have the visibility of when you can load, when it will arrive, so you can hedge if you have the volume, if the liquidity is there, which I don't know. But I don't know. I'm just, I'm asking questions more than giving answers.
Yeah, but I think refiners will struggle to hedge this thing. I think there's a psychological factor which says, I could completely blow my P&L if I try and bring this super expensive crude over to the east, and then Trump calls peace tomorrow. And the other factor is probably psychological. How much longer can this last? Maybe I can defer buying or delay buying until next week again. Plus, I can ask the government for cheap SPR crude. It's going to be SPR crude is the cheapest crude around. Maybe it's the combination of those things. And then the Indians are taking more Russian. The Chinese are taking more Russian. The Chinese are relying on floating storage offshore of China, which is Venezuelan, Iranian, Russian from the prior months. Maybe it's a combination of those things. I don't have the answer, but I'm just following the data. The physical market's not moving. It's just paralysis.
Maybe that is also, we were talking about this. There's a lot of paralysis in the market in general, whether it's refiners, traders, etc. There's just a lot of paralysis. You have movements on flat price of, what was it on Monday? I think it was like $30 a barrel in one day. When the market doesn't move by $3 or $4 a barrel in 15 minutes, we're now getting bored. It's just insane. Yeah. But anyway, so sorry to interrupt. I just, I thought it was important to focus a bit on this cash story because there's a lot of uncertainty there. But sorry, go.
No, that's about it. I basically lined it out. I think lower freight rates in the West will help move things. I think we talked about that on day one internally of this crisis. Now you have the situation where you have a bunch of VLCCs that can't enter the Straits, and you had some that actually exited over the last few days, and that all goes somewhere else to cash in on good money on a safe route. And then now we're seeing it, loads of ballasters to the West, and that will help push the rates lower. The FFAs already came off a lot for TD20, TD22, 25 even. So I think it's heading lower directionally as well. That will help to move the physical market, presumably.
And the refining margins in Asia going up even more. Yeah. I would say. And should we wrap up with fuel oil? Can you tell us a little bit about fuel oil?
Yeah, just a note on fuel oil, because fuel oil also has a problem, right? There's, 500,000 barrels per day that used to be exported out of the Strait. And we've got Asian run cuts that might do another 500,000 of supply reduction. And the problem with fuel oil is the demand is more inelastic than for other products, because you cannot have a situation where cargo ships and tankers A cannot move, or B get stuck in the middle of the ocean or stuck in some random port. So the fuel oil market will have to bid up against things like gas oil to make sure that at least some of this supply gap is plugged. And just to note, on our platform, we actually look at those things. We have a break-even blender margin for blending 10 ppm diesel into the VLSFO pool. And we saw that remarkably open up for a few hours yesterday. And so you can already see the VLSFO pool is pricing up to try and get more molecules from gas oil. That's the last thing you want when you're massively short of diesel. So it will make the situation...
I'm not a fuel oil specialist, but, we are saying that despite unprecedented gas oil flat price, maybe not unprecedented flat price, but the spreads, the cracks, everything, fuel oil is still cheap enough to go into a fuel oil pool, or it was for a short period of time?
It was for a few hours, but the spreads on VLSFO in Singapore are absolutely huge as well.
Just, even if it doesn't happen, just the fact that it got close enough for people to consider, that is the story here. It's not so much how much volume was blended or anything like that.
Yeah.
Probably, maybe at the end, nothing gets blended. But that's telling you that, if anyone is thinking, oh, diesel has gone to the top, well, any kind of drop in diesel will find support, because then VLSFO will start saying, hey, here I am.
Yeah, and if diesel cracks rise, you're going to need to see fuel oil cracks rise, because you can't have the spread get too wide between them at this point in time, which makes sense. Yeah, and the other thing you can do to solve the problem is to stop converting sort of low sulfur resid into clean products like gasoline. And we saw those margins drop off, the RFCC margins, we've seen them drop off. They're not particularly low, but it could be that VLSFO also attacks, so to speak, the gasoline supply sector, if you like. And all this will help. It's not a panacea to put endless amounts of gas oil molecules into fuel oil, because there's spec issues that you run into reasonably quickly. But it's just funny to note all these things, like every product except kind of naphtha is really calling for its share of supply, let's say.
Yeah, what a moment to be alive, huh? Unbelievable. So ideas, even far-fetched ideas that you might have in terms of, trading opportunities?
I've got one. I wrote down a couple, but I think there's a situation where margins in Europe might even go down. I mean, if you flood the market with diesel, maybe that's some temporarily, right?
Yeah.
It's kind of the same as the crude market being so weak in the West in terms of physical diffs. Maybe diesel in Europe gets temporarily quite weak. It was already...
If the SPR is released, then you on diesel in Europe, you might find a similar situation to what happened on crude with the announcement of the SPR. Is that what you're saying? Yeah. Mm-hmm.
In the West, yeah, maybe. I mean, anything's possible, because there's just such big changes in like prompt supply and prompt demand.
Get the timing right, though. I mean, that's a very tactical move, but the story here is still still bullish. At least on the distillate side.
Yeah, but by inference, you're bullish. Then that's a bullish call on the East-West as well, right? Yeah. Wow. The front at 200. Yeah. Okay.
No, the East-West is going to be an interesting one. I think it's going to be flip-flopping a lot. That tension between who's shorter on diesel, and that's going to be an interesting one.
Kind of a little bit untradeable, I think, at the moment. It's yeah.
Well, I mean, these are our ideas. What can you trade? That's a different story. What is the liquidity there and all that, and what is the appetite? I mean, well, normally traders should have an appetite for risk, but I would also say Brent, it's now at 92. I'm not saying that we should rally in one day $30 a barrel or anything like that, but as we said last week, from day one, the story is on products. The crude seems to me like it's being, it's the headline number, and that's what Trump and the governments are trying to contain, but it still seems like cheap at this stage, I would say.
I've got something to add to that. I totally agree, but just a sort of anecdotal thing. I saw in the Financial Times yesterday, they did a scenario analysis on world GDP. Let's say, and they had, say, this conflict lasts 3 months plus lasting damage to Gulf energy infrastructure. They had reduced world GDP by, what is it, 0.5 percentage point? And it just feels, I don't know, that for me, that the gut feeling, that feels wildly optimistic. Like
I would that gut feeling as well, but yes, I would expect much more than just 0.5. Yeah, for sure.
Yeah, and
because again, you're not only talking about oil. I mean, obviously we talk more about oil, but gas. 20% of gas supplies in a European market or OECD, at least OECD market, in a shortage of it. It seems a bit low, but
I mean, because all of it sounds a little bit depressing, but it's going to be part of the reduction in the economy is going to be part of the solver, right? Part of the demand destruction. If this goes on, that has to be part of the solution.
Yeah.
Wow.
Okay. Well, guys, thanks a lot. Great to see you. And thanks everyone for listening. We will keep you informed as things progress. Thanks guys a lot for all of the efforts this week. It's been amazing, all the content that you've been producing, and
thanks
on a
very
timely
much.
fashion. So it's worth praising. And we'll keep bombarding you with our insights and with news, and trying to distinguish between insights and noise. But again, all very fluid. Whatever we say here in terms of a trading idea might change radically in 10 minutes if Trump announces something different. We'll see. But at the end of the day, we're trying to focus on the real story around physical infrastructure, trading opportunities that we see in the market, not the things that we cannot control, like potentially the Treasury selling crude swaps
Reportedly.
At the end of the report, apparently. But let's not forget that the Treasury Secretary was a hedge fund manager himself. So, let's see. Anyway, so guys, thanks a lot, and keep in touch. Cheers.
Thanks very much.